Good day, ICT traders. This is Divine FX Capital, and today I promise I'm going to be teaching you guys on a very important topic in the ICT concept, which is the ICT in 7 institutional reference points. And this is a very subtitle. It's a very interesting topic to pay attention to in the market. Obviously, I've not been trading for some weeks now because we are in the month of August, and August is not a good month for trading because the institutions are going on holidays, the banks, the financial markets, the market makers, the smart money, all those guys are going on vacation because August is what? Is a month for vacation on this. So we are going to be expecting less volatility in the market. So since all this why I've not been trading for a couple of weeks now, so I am on break. So when I'm going to resume in the month of September, so we are going to flow together as I teach you guys. So, paying attention to this title, this is a 7 institutional reference point, and from this 7 institutional reference point, it is simply a reference point place or area where institution apply their movement. It is an area where the institution tends to take their movement or tends to react from. Those places we call our point of interest, our key level. These are going to be the institutions, the 7 institutional reference points. These are areas we are going to be paying attention to. The 7 institution is just simply an area where the financial markets, the banks, the big boys are trying to take their trade, are trying to react from. Those area we call our point of interest or our key level. So from the 7 institutional reference points we have here, we have number one, we have the mitigation block. Number two, we have the breaker block. We have our liquidity void. We have the fair value gap. We have the fair value gap, and also we have the order block. And after the order block, we have the rejection block, and we have the old highs and old lows. There are 7 in number. So and these institutional reference points are arranged in their order of importance. Very important. They are arranged in their order of importance and in their order of preference. So just pay attention to this institutional reference point. So which means a mitigation block is more stronger than a breaker block in a key level. A mitigation block is very stronger than a breaker block, and the breaker block is stronger and active than a liquidity void, and a liquidity void is very stronger than a fair value gap. A fair value gap is stronger than an order block, and an order block is stronger than a rejection block, and also a rejection block is stronger than an old highs and old lows. So this is why they are arranged in their order of importance and in their order of preference. So when you see all these institutional reference points, just know that they are arranged once in their order of what? In their order of preference and in their order of importance. So let me use an illustration and teach you guys how to pay attention to this institutional reference point, how to find this institutional reference point, how to spot them, and how to use them. So without wasting much of your time, let's go to the chart. Let me give you an illustration. Let's say, for example, we have a range. This is our range. And as an ICT trader, you know market structure is very important. We have to pay attention to market structure to know where the market is going. If market structure is showing break of structure to the bearish side, you know that we are bearish. If it's showing break of structure to the bullish side, you know that we are bullish. So from this illustration, we have a dealing range, which is what? This is a break of structure. This is a break of structure to the upside. And from this illustration, we have 2 points. We have there's something we called premium and discount. So when you pick your Fibonacci level and place this from premium to the discount level, you will see that price is what? Price is bullish. So when you are expecting to go bullish as an ICT trader, after marking your break of structure and after marking your break of structure, you apply your Fibonacci level so that you will know when price trade into the discount level for you to what? For you to keep buying. So for you to buy in this particular zone, which is the discount level, that is when you are going to bring out the institutional reference point. Now you are going to pay attention to an institutional reference point that is going to be around this area. Is it a fair value gap? Is it a fair value gap? Or is it going to be an order block? Is it going to be an order block? Is it going to be a fair value gap? Is it going to be a breaker block around here, or is it going to be a mitigation block? So this is how to spot out the institutional reference point. So from this illustration, we haven't seen any institutional reference points yet. I'm going to go to the chart and show you guys how to spot it, but this is to show you that the institutional reference point is mostly spotted when you have a break of structure and you are expecting price to trade into a discount level or a premium level. So institutional reference points are found into what? They are found into a discount level of the PDRA or what? A premium level of a PDRA. So for example, let me show you an example of a mitigation block. So from this first diagram, what is a mitigation block? A mitigation block is said to form when we have price, for example, going to a bearish direction. Price is going to a bearish direction after trading into a key level. Let's say price traded into an institutional reference, a key level around this area, and what happened? The moment price traded into that key level, price shifted structure. Price shifted structure. So this is a mitigation block. A mitigation block is said to be formed when we have a failure swing. The moment price traded into your key level, went up immediately, retraced, couldn't take out the old high, couldn't take out the old low rather. Price failed to take out the old low. Instead, price left us with what? A failure swing. This is what? A failure swing. And the moment price created that failure swing, it shifted structure. This is what? A mitigation block. This is what? A mitigation block. So this area should be your point of interest. This area should be your point of what? Interest. This is what we call a mitigation block to go what? To go bullish. So mitigation block is said to form when we have a failure swing. Remember, we have a failure swing, failure to break below the previous low before it shifted structure. This is what? A mitigation block. Then you can take your trade from this area. From the mitigation block, your stop loss should be below this low, and what? You target the other highs. This is how to spot a mitigation block. This is a bullish mitigation block. The same thing is most likely going to be available in a bearish mitigation block. You just want to see price give you what? Failure swing, price going bullish to the upside at some point. Price gives you what? A failure swing. So this is what? A mitigation block. After the failure swing, this area should be what? Your mitigation block to trade bearish. So this is how to take trade using the mitigation block. You see, this is how to take trade. This is how a mitigation block is formed, and this is how to take trade using the mitigation block. So you are expected to take the trade the moment price shifted structure. The moment price shifted structure around this area, trading into a key level. This is what? A mitigation block. This is what? A mitigation block. You take your trade in the mitigation block, and your stop loss should be a little bit above the failure swing. So this is a mitigation block scenario. So let's dive into the second example, which is a breaker block. Let's dive into the second example, which is our breaker block in their order of what? Remember, it is still according to their order of preference. So a breaker block is said to form when we have price targeting a point of interest or a draw on liquidity. Example, Price is giving us series of lower lows and lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, going to what? That key level. So the moment price tapped into that key level, you know, cleared liquidity. Cleared what? Liquidity before the shift of market structure. This is what? A mitigation. This is what? A breaker block. So a breaker block is set to form when price traded into a key level or your point of interest, sweeping liquidity. Mitigation blocks always sweep liquidity. Some ICT traders call it turtle soup. This is what some people called turtle soup. It sweeps liquidity before it changes direction. This is what? A breaker block. This is what? A breaker block. So coming back to this key level, coming back to this area, you are taking your trade. You are taking your trade the way you take it from the mitigation block and what? And target the opposite direction. But just know it in mind that a breaker block sweeps liquidity before it shifted structure. It sweeps liquidity, it take out liquidity before it shifted structure. So this is how a breaker block is formed. So whenever you see this scenario, just know that it is what? A breaker block. The same thing is applicable on a bearish side. You want to see price sweep liquidity, sweep liquidity. You see it? Price sweeps liquidity above, then shifted structure. So coming into this guy, this area is now our breaker block. You are selling from this area. So this is for the breaker block. Another example is for the for the liquidity void. A liquidity void is set to form. Let me use the chart for example. 15 minutes time frame. Let me show you an example of a liquidity void. A liquidity void is an area of imbalance where price displays with a momentum. Price tends to displace with a momentum and price coming back in the future to fill it up. So for example, this is a liquidity void. A liquidity void is mostly formed by news spike or when there is a high volatility movement in the market. So this is a break of structure here. This is a break of structure around this area. We have a break of structure. So this is a liquidity void. This candle, you see this candle, these two large candle that created a displacement. This is what we call a liquidity void. When price tends to move significantly from the particular candle, you can see the momentum of the candlestick is very large. So this whole candle is what we call a liquidity void. This whole candle is what we called our liquidity void, this whole candle. So the moment price trade into this candle, sorry, this whole candle is tend to this is the liquidity void. So this is a liquidity void. So whenever you see a momentum candle, a particular candle move within a range or its previous candle with a momentum, this is an imbalance. This is called a liquidity void. Price is going to come back in the future, in the nearest future, and fill it up to the 50%. So if you pick your fib level and measure this liquidity void, you will see that price later comes back to at least 50% and what started displacing to the upside. So this is how a liquidity void is formed. Let me show you another example of a liquidity void. Kindly go to your chart and backtest all of this. A liquidity void, backtest all these institutional reference points and you are going to see how they works. So this is another example of a liquidity void. You can see how price displaced with momentum of candlestick closing below each other. You can see how this one closed below below this candle, and this candle closed below this candle. So this is what? This is a liquidity void. Price tends to come and fill it up in the nearest future at least to 50% of this candle. So if you measure from with your fib level, that is why Fibonacci level is very, very important. You can see how price later came back in the future to trade at least into 50% of this range and displaced to the opposite direction. So this is how to trade using the Fibonacci, using the liquidity void. So another example is Another example is what? Another example is our fair value gap. So a fair value gap, you guys know a fair value gap. As an ICT trader, you have to pay attention to fair value gap. Any ICT trader that didn't know how to use the fair value gap to trade or didn't know how a fair value gap is formed is definitely lacking behind, because you are going to take a lot of losing trade in the market. So a fair value gap is when we have the first candle and the second candle close, the third candle, this is a fair value gap. A fair value gap is that imbalance in price action when we have three candlestick price action. You can see we have three candlestick price action. The first one here, the middle one, and the third one, leaving us an imbalance in the middle, leaving us what? A space, a vacuum at the middle. So this space is what we call fair value gap. So whenever you see a vacuum, look at them. This is another example of a fair value gap. Let me show you another example of fair value gaps. This is another example. You can see three candlestick price action. Price created the first candlestick, the second one, and the third candlestick, leaving us with what? Leaving us with a gap, an imbalance. So if you start from this gap to this place that the space occur, mark it out to this area. This is what? A fair value gap. And the smart money, the institutions, the big banks uses fair value gaps to activate their trade. So you can see how price traded into this fair value gap immediately and change direction to the upside. So this is how a fair value gaps works. So you can simply take your trade using this fair value gaps, the consequent encroachments, which is the 50% of this area, to take trade. This is what? A fair value gap. And you can see how this market dished out immediately. So this is how fair value gaps work. So another one is another famous institutional reference point you guys know, which is the order block. Which is what? Which is the order block. An order block is the last buy or sell candlestick that occur before price changes direction. Let me show you example. So this is an order block. Let's say price broke structure. We have a break of structure to the downside. I'm looking for a very decent example to give you guys. Okay, this is an example of another block. We had a break of structure here. Price broke structure here. This is a break of structure to the downside. And what happened? This is an order block. The last buy candlestick that tend to happen before the break of structure is called an order block. So this is our order block, and this is our order block. You mark it out from the beginning of the candlestick to the closing of the candlestick. You mark it out like this. This is what? This is a bearish order block. You mark it out immediately. So you can see how price came back and tapped into that order block after price broke structure. You can see how price came back to the institutional reference point immediately, tapping this area, tapping the order block. And what happened? Immediately, the big banks, the smart money, that reacted from that order block. You can see how the trade reacted. You can see how the trade sold immediately from that order block. So this is another example of another block. This is an order block. So let me look for another example of what? Of an order block. So this is another example of an order block. This is a break of structure. We have a break of structure here. Price broke structure to the upside and coming back, price tapped into this. Or remember, I told you guys that another block is the last buy candlestick or the sell candlestick that was formed before the change of structure. So this is what? This is an order block. You can see price went up, retraced. So this is the last candle that formed the retracement before what? Price broke structure to the upside. So you are going to mark it out like this. The full candle is our order block. Mark it out. You can see how price traded into the order block mean range hold. The 50% of an order block is called a mean range hold, and price sold off from the order block. So this is how to trade using what? Using the concept of an order block. You can see how it's dished out immediately. So this is how to trade using an order block. Another example in this area is a rejection block. A rejection block is simply an area where price rejected with the wick. where price rejected with the what? With the week. Price coming back into that area once more and reacted from that what? And reacted from that particular area. This is how rejection blocks are what? Are formed. So this is an example. Let me see. This is an example of a rejection block. This candlestick right here that formed a wick. You see this wick? This is a rejection block. You need to mark it out. A rejection block is simply a wick that was previously formed from an old price action. You see, we have a break of structure here. This is a break of structure. This was a rejection block that formed before the break of structure. Price what? Price left this rejection block for a purpose or for a reason, so that the institutions are going to use this what? Rejection block. So you can see how price, after moving, creating series of break of structure to the upside, creating series of structure to the upside, price later came back. Price later came back. You can see price later came back to that rejection block, tapping into that rejection block. This area, you can see how price traded into the rejection block, and what? Boom, the movement started. And this is another example of how to take trade using the rejection block. This is how to activate your trade using the rejection block. Stop loss below the rejection block, and what? You target. I'm not teaching strategy here. I'm just teaching you guys how these things works in the market. And kindly go back to your chart and backtest these things, guys. These things works 100%, 90% to 100% of the time in the market. So this is a rejection block. The week, it's just an area of liquidity. Let me look for another example for you guys. A rejection block. Okay, guys, look at an example of a rejection block. An old high. This is an old high that price left with a rejection block after sweeping liquidity below here, above here. Price swept liquidity immediately, left us with what? A rejection block. Remember the week. This is the week. You mark it out. This is a rejection block. So you can see how price came back in the nearest future and traded into this rejection block, and what? Sold off immediately. You can see how subsequently, the entries I teach you guys, you can go to the lower time frame and look for confirmation to sell. But I'm not teaching you confirmation. I'm teaching you institutional reference point, areas where the smart money, the big banks, tends to move the market or tends to react from, to sell or rather to buy. So this is another example of a rejection block. And the last but not the least is an old high, an old highs and old lows. Let me see an example of old highs and old lows. Old highs and old lows. Old highs and old lows. Let me look at gold. Let me use gold for the example. So this is gold from the 15 minutes time frame. This is an example of old highs. Let's look for an example of old highs and old lows. Okay, this is an example of old low, guys. This is an example of old lows. You can see this is a low that was previously formed before. These areas can be these areas can be a previous point of interest. This area can be formed. It can be 2022 key level. It can be monthly key level. This is just an old low. You can see this body. This is a previous old low. Price later came back and reacted from that what? Reacted from that old low, and what? You can see how price has been moving bullish. So this is an old low. An old low is sent to form is an area of price action where price reacted before. After moving to a particular direction, it tends to come back to that area and react to that area before moving to the opposite direction. So guys, if you find this video important, please kindly subscribe to my YouTube channel. This is Divine FX Capital, where I mentor students on how to trade using ICT concepts and become profitable. So with time, I'm going to be coming to this area, to this era of YouTube, to teach you guys, you newbies, from newbies to intermediate to professionals, how to trade using the smart money concept and ICT trading concept. So kindly subscribe to my YouTube channel. Subscribe, subscribe, and subscribe, guys. Thanks and peace out.